Securities Act of 1933, Chapter 4, National Security, NSD, National Association of Security Deposits. There are two major federal security laws in the United States. Security Act 1933, our topic section covers the offering of the new security-related matter of the Security Exchange of the 1934 that converts for the virtually all other matters. For example, the 1934 Act established Security Exchange Commission, the Stock Exchange registered with the Stock Exchange Commission under the amendment of itself with the NACE to regulate the over-the-counter market. It is authorized by the Federal Reserve to establish margin requirements for the security transaction, covers many other regulatory areas. Securities Act of 1933 enacted to prevent fraud issuance of the securities is sometimes called the full disclosure law, with required with the registration statement to be filed with the Security Exchange Commission that contains all information available regarding issuing the company and the detail of the particular offering. The information is given to the prospective purchaser in the form of the prospectus. The exemption will be discussed later with the registration statement that must be filled with the company wishing offered the security with called the issuers. This is considered the affiliated person of the issuer. Of that issuer. Affiliated person is one who has the ability to influence the policy of the corporation, such as chairman, president, and controlling stockholder. Securities Exchange Commission never approve the issue, nor do they generally disapprove of the one. The attempt to see if the information provided with the prospective is sufficient to permit investors to determine the suitability of the investment of the particular portfolios. Many security offerings, except for the filing requirements active among them, are U.S. government security, municipal security offering, charitable institution, intrastate offering, commercial bank exception, certificate of deposit. Security exchange must register with the government agency, railway equipment. Trust certificates must register with the Interstate Commerce Commission with the insurance policy and fixed annuities. No except for the registration. Security Exchange Commission require the briefer, less expensive form of the registration offering under the Regulation 8 of the Act of the offering may not exceed total value $5 million made under the offering circular rather than in prospectus. The $5 million limit of the Regulation A coverage of the offerings made with the issue of the 12-month period with the other expected offering private placement offerings made under the Security Exchange 144, 144A, 145, 147, 237. The exemption of the group of entities defined with the accredited investor and Security Exchange Commission Rule 505 private placement to distribute the number of the accredited investments but no more than 35 non-accredited investors during a 12-month period. The term of accredited investor includes financial institution, investment companies, banks, insurance companies, etc., non-profit organization with excess of $5 million or more, any purchase of at least $150,000 of the securities being offered. Individuals with net profit excess of the $1 million, individuals' income with excess of $200,000 in each of the last 2 years, with the exemption of this level that will be achieved in the year of the purchase. Rule 144 states the stock that acquired privately with a compensation must be held with a minimum of 2 years fully paid basis before eligible for sale. Under this rule, stock acquired with the open market with affiliated person not subject to the 2-year requirement. Suppose the president of the Acme Engine Incorporated, which sold 25,000 shares of the company stock with regarding registration sale of the Security Exchange Commission, with which she might approach Goldman Sachs Group Incorporated to assist her with the sale, assuming the Acme Engine stock is listed on the New York Stock Exchange. Step 1. Goldman Sachs would check the Security Exchange Commission to see if the Acme Engine was the reporting company of the buyers. These shares will not receive the prospectus. The information regarding the company must be available to them. Step 2. If the amount to be sold with more than 500 shares, more than $10,000 value, the notification of the sale must be given the Security Exchange Commission. Notice Form 144 allows the sale to take place over the period of 90 days as part. It is not to depress the price of the share that is for sale. Seldom would this much time be needed. Step 3. How much of the person can sell. In a 3-month period, the person can sell the 1% of the outstanding stock of the share listed on the exchange, average a week volume for the last 4 weeks, whichever the greater. Suppose Acme Engine had 2 million shares outstanding at 1% would be 20,000 shares on sale of 25,000 would be excessive. However, the Acme stock listed at the New York Stock Exchange, Goldman would check the volume for the previous 4 weeks. Consolidated network A. Suppose they found the volume of the 4 weeks ago 40,000, 30,000, 48,000, 30,000, 52,000 shares 1 week. The sum of the 4 weeks volumes of 170,000 shares divided in 4, obtaining an average volume of 42,500 shares. This could sell up to 42,500 shares, making or sale of 25,000 well within the limits of Rule 144. Keep in mind that covers the unregistered shares over the 3-month period, allowing our client to make for such sales a year and computing the amount that may be sold under Rule 144, consider the unregistered sale of the same security of the president of the Acme Engine had sold shares in a registered offering last month that would not be counted. She also may also you sold convertible bonds, convertible preferred stock over the company, but this would not affect her limited on the sale of the common stock under Rule 144. Step 4. General dealers, Goldman Sachs and Group Incorporated, handling Rule 144 sales cannot solicit and buy orders for the share that are sold at the general market exchange over the counter of the normal manner. Goldman can buy some or all the shares themselves acting as a principal and can sell them for the client acting as an agent. The firm handling the sale cannot charge more than normal commission for the trade decided despite of the fact some of the additional work of the part may be necessary. Step 5. The details of the sale would be recorded in the Securities Exchange Commission. Rule 144 rules allow the purchase of restricted stock organization, classified, qualified institution defined to have the minimum $100 million invested security not affiliated with it. Any qualified institution may trade among themselves without regard provisions of Rule 144 outlined above. Rules 145. Rule 145 allows the sale of unregistered stock acquired with the merger or acquisition. Perhaps you own a factory in Ohio that you sold Acme Engine and received the unregistered Acme Engine stock as part of the payment. After holding the shares for 2 years, you could sell them under this rule. The details, permissible amounts, the time factors are the same as the Rule 144. In short, the two rules are same, except for the manner in which the stock is acquired. Rule 147. The rule covers the interstate offerings that allows the sales to meet the limits of the rules to be made without registration. The Security Exchange Commission over the offering must comply with the laws of the particular state. Company wishes to offer shares of the stock in Texas that qualify for the interstate offering with the following requirements must be made. The offering must be made only to the bona fide Texas resident. The buyers may not sell the share of the non-Texas resident for a period of 9 months. The principal office of the issuing company must be in Texas, although it may be incorporated elsewhere. 88% of the proceeds offering must be used in Texas. 8% of the corporate assets must be in Texas. 8% of the corporation's revenue must be earned in Texas. Interstate offerings are as rare as few corporations would meet the stringent requirements. Rule 237, for infrequently use of the permits limited to the unregistered security, the company would notify the lessor of the Security Exchange Commission. Holder may sell to the lessor with a 1% outstanding of $50,000 in value, 12-month period provided. 1. The Security Exchange is notified 10 days before the sale. The corporation has been existent for 5 years. The seller has owned securities for 5 years. The seller price is negotiated without service over the broker or dealer. Registered offerings. When you devoted much study of the issue that can be offered without Security Exchange Commission, let us now turn our attention to the offerings that require registration requirement of the issuing of the debt securities of the Found with the Trust Indentured Act of 1939, which is amended to the Security Act of 1933 in order to provide investors with the necessary information. The law requires the offering of a debt security with the amount of $1 million or more made under the trust indenture. The indenture is the contract between the issuing corporation and the investor, contains all necessary information regarding the issue of the amount, interest rate, and the collateral, etc. The indenture must appoint one or more of the trustees who have no conflict of interest. The additional problem, the bondholder trustees must make an annual report of Security Exchange Commission showing that they continue to act in the capacity. The most effective way to understand procedure of the making a public offering of securities is to take a hypothetical deal from step 1 to its conclusion. Suppose 10 years ago and 3 friends established Acme Toy Company Incorporated, manufactured, sells, distributed dolls, stuffed animals, other toy products, would probably have a small amount of authorized stock, perhaps 1,000 shares, would have issued perhaps 400 shares, 100 shares for each of the 4 founders. You would also each have owned 25% equity in the corporation. We've authorized 1,000 shares issued and outstanding 400. After 10 years of growth, you may now wish to expand your business, constructing a new factory in California. You estimate the cost to be $10 million. As your company needs the longer-term capital you approved for the investment banker, had you required short-term financing, you would have either the commercial bank, Citibank, or Harris Trust. You approach Goldman Sachs Group Incorporated, detailed the need of the Goldman Sachs with the research of the company as well as the toy industry. General market conditions make with a recommendation how the need of the capital be raised. You might suggest Acme Toy would be total worth of $20 million marketplace, and $10 million could be raised with selling half of the company. Although 4 founders would only have half the stock, the company would be larger. Also, there would be a public market for the shares, allowing them to sell some of the holdings should they so the desire. Implementing of the sale of the low capitalization would have an increase of the current stock split. According may amend the charter of the new capital structure might like this. Acme Toy Company common stock authorized 3 million shares, issued and outstanding 1 million. The 4 founders of which each now own 250,000 shares, still represent 25% of the total. However, the assistance of the Goldman Sachs company would now be a public, offering additional 1 million shares. Offering there would be 2 million shares outstanding, and our founders would actually own a total of 50% of this new larger publicly held company. Offering would primarily offer the shares as being sold by issuing companies should the founders wish to sell some of their shares. There would be a secondary offering preceding the sale, which sale would go to the shareholders, not to the issuers. Most offerings are part primary and part secondary. Goldman Sachs would manage the underwriting offering and would proceed as follows. Step 1, registration. Registration statement covering the issue would be filed with the Securities Exchange Commission minimum of 20 days until the effective date of the day of the Securities Exchange Commission teller issued registration statement effective that the public offering may commence, and the fact of the time could be longer than minimum period of 20 days. Know that February 1982, the Securities Exchange Commission enacted Rule 415, which permits major companies to file which are called shelf registrations. Rule permits the larger public companies to file with a single registration statement covering anticipated financing needs for a 2-year period. Securities can be brought to the market anytime during the period in a whole or in part as the company desires. The rules now not requiring separate filing for each of the offering all issuers to move quickly with the market conditions or advantages. Step 2, issuing a red herring. The part of the registration statement, the preliminary prospectus, called the red herring because of the red legend covering the notes of the incomplete nature of the information. Red herrings contain much of the information regarding offering, but seldom contain the price of the normally determined by offering date based on the current market conditions. Preliminary prospectus can be used to familiarize potential investors with many facts about the issuing company. Step 3, formation underwriting group syndicate. Goldman Sachs and the manager would invite the investment banker to participate in the offering. Perhaps 30 to 40 firms would be asked to participate in order to group the distribution. Shares create interest in the company to the financial company. Goldman Sachs would take the largest amount, perhaps 200,000 shares, when offer participation to the other firms. Varying amounts known as brackets. Other syndicates included in part the following firms: 200 shares of Goldman Groups Incorporated, Bernstein's Company, Dutch banks are Key, Brunet, Windsor, and Merchel Lent, Swiss American Securities, all 50,000 shares to be underwritten. A.G. Edwards, William Blair, Legg Mason, and Prudential Securities, 40,000. Other firms would be invited to underwrite smaller amounts. Note that each bracket of the firms are listed alphabetically. Firms are quite conscious about the bracket in which they appear. Would sell them a set position that fell to be below their dignity. Underwriters do not sign any final commitment, but do sign an agreement among the underwriters which give the manager Goldman Sachs complete authority to make the decision regarding the offering. Step 4, due diligence meeting. The meeting between the issuing corporation and the underwriters to discuss the offering. Although the offering price is not set at the meeting, it gives the underwriters the opportunity to further investigate the issue and protect the interests of their clients. Step 5, blue skying the issue. Blue sky laws are security laws. Various states, in order to offer new issue, the state must comply with the requirement the manager provides the underwriters with the blue sky list, which affords them the status within each state. The issue may not be blue skied in all states, therefore sales shares, and those would constitute violations. Step 6, public offering. The manager would be in constant touch with the Securities Exchange Commission. Might be told, for example, the registration statement will be effective next Wednesday. Manager would call the meeting underwriters in the morning, which would time the price would be determined. Perhaps the agreement would call for the underwriters to purchase security for the corporation at $10 per share, offer them the public at $11 per share. This would allow the gross profit call for the gross spread $1 per share of the 1 million shares. Thus, underwriting agreement in terms of would sign an underwriting agreement in which each firm would agree to purchase the portion of issue of the reoffer to the public. Underwriters act as severally but not jointly, meeting each is responsible only for its own stock. Thus, William Blair Company agrees to purchase 40,000 shares from a company at $10 each, but is not liable for the share underwriting by the other firms. Goldman Sachs would take the management fee, perhaps 10% or 10 cents on all the shares underwritten. So offering at this point would be offer the price of the public, paid to Ace Toy, gross spread $1, management fee 10 cents, underwriter's fee of 90 cents. Final prospectus would be now published, and any purchase of the share and any omission, misrepresentation, fact documented would bring a liability of the representative under our 1933 Act. A tombstone ad might appear with the newspaper the next day announcing the offering. This is an ad not offering to sell the shares but a matter of recording only. If the demand of these shares is greater than the immediately sold, the manager would terminate offering the share, would begin with the trade in which is called the aftermarket, which overcounted market after the public offering has been completed. On May 23, 2004, Rule 2790, the National Security Association Security deposits became effective. The rule seeks to protect the integrity of the public offering process of the regulating initial public offerings are allocated regardless of second market pricing. The two significant changes within the rule: the first, firms must receive of each personal account within 12 months prior to any of the allocation of the IPO. Representation of the person accounting eligible is not restricted person to receive the new issue securities. The definition of restricted person covers several categories. Rules defines if the term include members of the other brokers, dealers, include broker-dealer personnel. This is further defined include any officer, director, general partner, associated person, or employee of the member of any other broker or dealer. Agents of the member, any other broker or dealer, are restricted person engaged in investment banking, security business. Restricted person also included immediate family members as well as anyone employed by the associated member and affiliate of the member. This includes anyone who has the ability to control allocation of a new issue. The rule went even further to include finders and fiduciary. Restricted person acting fiduciary capacity would include managing underwriters, but included not limited attorneys, accountants, financial consultants. The rule also treats as restricted person immediate family member of the finder, fiduciary, and the finding fiduciary material supports receive support from immediate member. Finally, the rule defines a restricted person: any person with the authority to buy, sell securities of the bank and a saving loan institution, insurance company, investment advisor, collective investment account. Rule 2790 excludes a person who has the authority to buy, sell securities of an investment club or a family investment vehicle. Second change allows a restricted person who holds interest collective investment private investment funds receive the IPO allocation provided with such restriction to hold more than 10% account beneficial interest. Term immediate family member to define persons: parents, mother-in-law, father-in-law, spouse, brother, sister, brother-in-law, sister-in-law, son-in-law, daughter-in-law, children. Either individual who has the person provided material support, not absently and are notably absent, are uncles, aunts, uncles, and cousins. Since the restriction applied with the IPOs, the old term hot issue is no longer viable. As the rule and regulation, there are exceptions and exemptions. The following is list are general exemptions. Investment company registered under the Investment Company Act of 1940. A company trust fund, similar fund described in Section 3A12A3 of the Securities Exchange Act of 1934, provided that one fundamental investment of 1,000 more accounts. 2. Fund does not limit the beneficial interest of the fund principal to the trust accounts restricted person. 2, 3. Insurance company general separate with investment account provided one account is funded premiums for 1 million or more policyholders. If a general account with the insurance company has 1,000 or more policyholders. 2. Insurance company does not limit the policyholders with the premiums are used to fund with the accounting principal to the restricted person. A general account with the insurance company does not limit the policyholder principal to the restricted person. 4. Account include fund limited to partnership, joint back officer, broker, dealer, or other entity with the beneficial interest. Restricted person does not exceed the aggregated 10% of the account. Public traded entity with the other than broker, dealer are authorized to engage in public offering new issue with the selling group of the member of the underwriter affiliated with such broker, dealer. This is one listed with the U.S. National Security Exchange, traded with the NASDAQ national market, and 3 non-U.S. issuers where the security meets the quantitative designation criteria of the listing of the National Security Exchange on trading of the NASDAQ national market. 9 investment companies organized under laws of the non-U.S. jurisdiction provided by the investment company is listed on a non-U.S. exchange authorized for sale to the public in the U.S. non-U.S. regulatory authority. 2, no person owning 5% or more of the share of the investment company is a restricted person. And ESRA benefit plan is qualified in Section 401 of the Internal Revenue Code, provided the benefit is not sponsored solely on the broker deal. The state municipal government benefits that is subject to the state with the municipal regulation takes exempt charitable organization under Section 501c3 Internal Revenue Code, church plan under Section 414e of the Internal Revenue Code. We've had successful offerings. How did they come about? Well, let's give it the large credit to the manager of the Goldman Sachs with the handle of the deal with the Goldman Sachs. They had full authority over the syndicate that told members how to make the stock with the underwriting and that they could retain their own sale. Perhaps they would have told that they had 50% retention. Therefore, Goldman Sachs had they were responsible for 200,000 shares retained only 100,000 Bearsteins, and the other firms underwriting 50,000 had only 25,000 to sell. 40,000 share bracket retained at 20,000, and the balance of 500,000 shares, or 50% of the 1 million, is put into the pot with which manager attempts to distribute on the behalf of the underwriting syndicate. If this manager succeeds, the deal is half sold, and the offering is on its way to be a happy conclusion. Manager distributes the pot in two ways. Group sells large sales made normally the financial institution on behalf of the group, and if this fund wishes to purchase 30,000 shares of the Ace toy, rather than to contact each underwriter separately with the Goldman Sachs request 30,000 shares of the Goldman Sachs, give them the share of the credit allocated to each underwriter in proportion to its position in the deal. At the time of the institution is permitted to designate the site credited with the forms of the wish to repay with the financial service rendered. Selling group that consists of the other investment bankers who wish to receive the portion issue for their clients. Perhaps Fidelity Broker requires 30,000 shares of its clients. As Fidelity is not underwriter of the issue of the Goldman Sachs Group, it may be given them shares of the selling group. They would be sold to Fidelity at $11 less than selling concession, perhaps 30 cents per share. Fidelity must offer their shares at $11 and cannot engage a free riding or withholding. They'll earn a profit at 30 cents per share, which is, of course, less than underwriter's profit because their selling group member does not bear the underwriting risk. There was no stock left in the pot. The Fidelity could have contacted any other underwriters attempt to buy shares at less than the reallowance. The reallowance is set by a manager. In this case, maybe 20 cents per share of the American Swiss Securities Incorporated had some unsold shares of the buy sale of the Fidelity at $11. Less than 20 cents reallowance. Fidelity would not make as much as would have the selling concession, but they will have filled with the customer's order. The breakdown of the offering looks like this. Offering price to the public $11, price to Ace Toy 10, gross spread $1, management fee 10 cents. We got 90, and then selling concessions at 20% reallowance, and underwriting at 60 cents. 60 cents underwriting minimum profit received with the members of the syndicate if the offering succeeds. Manager also keeps his close touch with the underwriters, might take stock away from one of them that is not moving it and give it to another who has demanded it. No, dealers cannot sell the security until the effective date. Prior to that time, they may only accept indications of the interest from clients, must contact the person again when the securities are offered. The manager has offered other methods of the disposal to assist offering. Alright, over-allotting. This is a fact of short selling. The issue of the manager causes more shares are sold than the total amount of the deal. Thus, no security is left in the pot. Goldman Sachs continue to give stock on the institution group sale of the dealer's selling group. They build up over-allotment. The short position, 70,000 share that will have to buy back in the aftermarket, thereby giving the support of the offering. They were wrong in the assessment of the offering. A large loss could result if the managers were shorted 70,000 shares. The stock began with trading at $15. The short position would have to be covered at a higher price. The resulting loss would be shared by the underwriters in proportion to their position. Often new issues contain green shoe clause, which allows the manager an option to increase the size of the offering, generally 10 to 15% under the same terms and conditions. If Ace Toy is offering 1 million shares at a 10% green shoe, Goldman Sachs could have increased their offering to 1,100,000 shares. They could have overallotted it up to about 100,000 shares without concern. If the stock did begin to trade at $15, they could exercise the green shoe option to cover the short. The term green shoe comes from the first offering that used the marketing device Green Shoe Manufacturing Company. Stabilization. If the artificially supporting the price of the new issue in the aftermarket, though it would be a period volatile, the usually security exchange policy, which prohibits market manipulation, is permitted as may prevent new issue with the declining value of the detriment of the investor. If on the offering date with the Ace Toy shares, manager fell with the deal but was not fully sold, it would employ the security dealer to make a bid on the open market below but never above the public offering price. The holding of the price of the near offering level, the bidding at $11 or perhaps $10.85 of the offering price would be reasonable. Underwriters would continue to make a sale as $1. They would have to sell the shares remaining of the syndicate plus of the repurchase for the course of the stabilization. Procedures may not succeed as the syndicate may buy shares back faster than underwriters are selling them. In this case, the manager would cease the stabilization, let the price fall. The underwriters will lose money, but that is the risk that they have to be paid to take. Stabilization often made by the syndicate penalty bid, which means the underwriters will be penalized their profit. Any or shares of the clients resold with the syndicate during the stabilization. As the purchaser did not hold the securities, underwriter did not do the proper job distribution. Loss of the profit, underwriters now distributing disturbing harm done to the firm's reputation affecting the distributor of the securities. Had the offering been successful, underwriters would have been a gross profit of $1 million. Management fees, expenses, selling concessions would have been deducted from this, but net profit would have been substantial. Sometimes underwriters is give them warrants for the company stock as further compensation. Warrants given to underwriters cannot have life longer than 5 years and cannot be exercisable below the public offering price. Once on air Ace toy deal, the underwriter could have received a 5-year warrant exercisable at $11 per share. Best efforts offering. We have the discovery of the firm underwriting in which investment bankers actually buy the share of the company, guaranteeing the price at $10 per share. In our example, some of the offerings do not contain the guarantee a call for the best effort of the offerings. In the case of the investment banker pledges to use best efforts, banks no guarantee in best efforts offering. Banker works an agent paid commission for the whatever he sells, but he has no liability for the unsold portion. Frequently, best effort offering is done all or none basis, meaning the no sale of the file unless the entire issue is sold. The banker might attempt to sell 500,000 shares, all of them none. As the client purchases a share, then their money is placed in the escrow. At the end of the also agreed period, usually 30 days, the money is given into the issue that all the shares have been sold and returned to the investor if less than the agreed amount was placed. Minimum and maximum offering. Further variation. Maximum offering. The type of offering will be a minimum number of shares may reach the higher maximum. For example, the minimum maximum 200,000 to 400,000 shares require at least 200,000 shares placed, that the total could grow to the bunch of 400,000 shares. Underwriters prepare the unexceeding negative developments due to the market out with the clause of the permits offering to be canceled. Some of the adverse events occurred with the issuing company should market conditions not permit the offering to be made successfully. Or standby offerings. These are done in connection with the right offerings by corporations. Shareholders should the Long Island Power Authority offer the right to the shareholder to purchase additional stock at $13 per share, but the company might employ the investment bankers to ensure the success of the offering. The Long Island Power Authority stock remains at $13. Rights would be attractive. However, should the price fall below the description level, the new shares would not be purchased. Investment bankers are paid a fee to stand by and agree to purchase any unsubscribed shares. Bankers will buy the rights from the holders who do not wish to use them and will sell the shares represented with these rights to their clients in the way the reissuing of the company is guaranteed they will receive the money for the new shares. Direct participation in programs and limited partnership, Chapter 5.